Hey, good morning, everyone. Marty Missouri here, July 31st, 2022, with your weekend stock market snapshot. Going to keep this one quick. Was able, though, to squeeze this in sooner than I expected. At one point, I didn't think I'd get it out to you till early tomorrow morning. But again, glad I'm able to get it done right here. Going to start with the long-term chart, the monthly S&P 500 chart, and work our way back to the 60-minute chart. So as you notice, folks, the market got special from Wednesday on. I touched on that, I think, a couple of times here on the blog. Chairman Powell clearly has markets in mind, despite a lot of the rhetoric, despite what a lot of smart people in economics and on Wall Street seem to think that the Fed is out to do a number on the market, do a number on the economy, because that's all they can do to ultimately bring inflation down to their 2% target. Actually, I don't disagree with that. I think their 2% target is out of reach without something severe in terms of the trajectory of the economy, in not a good way, and of the markets. Right now, our economic assessment actually is recession, but nothing devastating. Actually, a pretty soft recession as recessions go historically. That's our assessment based on all of the information and the data that we have at our disposal at the moment. These things are always dynamic, always subject to change. We never wed ourselves to our thesis, so everything is a work in progress as we see things right now. I still like our downside target, which is 3,500 on the S&P, which is probably a good 15% though, below where we are right now after this move. So the MACD sell signal is still very much intact, and that's very meaningful on the monthly chart, as you can see historically, and I've done this a dozen times or more over the last year or so. You know, this was a 35% drawdown. This was, call it 20, 16, call it 20, 57%, 50% drawdowns. But you know, now I can say on the monthly, we're seeing something that, you know, could have the bulls hopeful. We're seeing some shrinking of the gap here between the MACD line and the signal line, and a slight upturn in the relative strength index. However, when we look back to true bear markets, typically you do get these notable bear market rallies even on the monthly chart, and then you see things begin to improve and maybe give folks hope, only to have that hope dashed. And typically we're about halfway through when you get this first reaction, this first meaningful move on the monthly chart. So we don't really have anything that meaningful other than a pretty good July for stocks. And then this dotted line, let me zero in on that a little bit. Our interim trend line actually closed just above that for July. The main downtrend line, we've got a long ways to go. It would not be at all unusual to come back and test that trend line. In the context of a strong bear market rally, that would be the norm. So while I think a lot of people have already called the bottom at around 36, I think on the S&P, I get it. I'm not willing to completely rule that out, but I am saying probabilities by our assessment point toward something lower than that. Doesn't mean that we won't want to dribble in, as we have a little bit with new cash that's come in, some rotation to sectors that we think have been beaten up enough or close to enough, and so on. So we are very active in terms of positioning our core portfolio in a manner that would take advantage of the next bull market, and or however you want to phrase that, the bear market bottom when it arrives. But again, I think we have to err on the side still of caution for the time being. Now, zeroing in on the weekly chart, same setup. Broken through here, this shorter term downtrend line had a falling wedge. As you know, that's a bullish pattern. Nice breakout, running right up against this 4150 resistance, and that looks potentially substantial. As you can see, we broke through it here, and boom, 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 several weeks, just 1, 2, 3, 4, 5, 10, 11 weeks or so, right on that line. Came up, tested the uptrend line off of the COVID low, and then rolling over, and then sure enough, tested it, looked like it survived the test. 3 weeks later, testing it again, finally failed, and then boom, 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 boom. Resistance up against that resistance once again, with the 50-week moving average looming above and this downtrend line looming above as well. So we'll see. This may be all this bear market rally right here wrote, but there's some pretty good momentum as well. So time will tell. Like I said on the macro video, the risk reward setup right here is beginning to thin if indeed we're still in the throes of an ongoing bear market, which is still at this moment our base case. The daily chart, again, all the same patterns. Broke through this trend line here, this channel. Nice break above the 50-day moving average, successful test. 200-day and the trend line above. As I illustrated in the last technical update, once the bear market is official and you go back and look at the last couple of bear markets at least, and many more beyond that, you tend to get one or more tests of the 200-day moving average. Here's where the bear market became official, more than 20% lower. We haven't even come close yet to a 200-day moving average test. And ironically, folks, right here, I was saying that 4,300, remember when we were talking about the prospects for this bear market rally, I had 4,300 as my highest upside target. Ironically, that will take us, if we get there, right to a test of the 200-day moving average. So again, there's a lot to like about the short-term charts in particular, but there's also reason not to, let the pigeons loose just yet. Getting close to oversold territory on the RSI. This is what that looks like. Here we are getting close. Look at the market reactions. Got close here, right? Look at the market reaction, and we're right there again. So reason to think that maybe we're getting close to all this bear market rally has to offer. I'm very open to the idea, though, that we could move higher as well. This is the kind of stuff I'm seeing when I say the risk reward here is beginning to get somewhat thin. And then the 60-minute chart, we have this channel, but we do have, if you look at that easily constitutes an upward wedge with some concerns down here in terms of the momentum dying right here. And, on the hourly, that's an overbought look. So it would not surprise me in the least to see the market sell off a bit early Monday morning. But there's weekend factors that are going on as well, not the least of which the China-US situation. If a US politician decides not to stop off in Taiwan or suggests that she's not going to, well, then the market might respond to that for a moment positively. If she does, could have a negative response within the market as well. And lots of headlines and articles you can read on that if you look it up. So in closing, I want to pull up the short interest on futures and just make a few quick comments there. So here's the net positioning for futures speculators in the S&P 500. Net meaning on balance, notably short the S&P in the futures market. This data comes to us each Tuesday. We actually can see it on Friday. So we had Wednesday, Thursday, and Friday, and the kind of rally we had last week, right? So I would guess that when we see next week's number, this is going to come off a bit, something like this. You can see here, big reduction in short interest, and I can almost guarantee you that came with a crazy strong rally back in June of 2020. This just adds incredible juice to the upside, as does options dealers positioning when we break through certain levels that I keep talking about. And recall that the latest mutual fund manager survey done by Merrill Lynch showed them exceedingly bearish and loaded with cash. And mutual fund managers are beholden to benchmarks, so they can't afford to sit on the sidelines if it looks like the market's going to ramp up in any kind of sustainable way. The sad thing about that is the managers may not even fundamentally believe that it makes a lot of sense, but their livelihood demands that they capture or beat a given benchmark. So anyway, folks, the point here is that positioning underneath this market really was lending itself to a pretty strong bear market rally. Now that these levels, with the somewhat overbought nature of the market, while I am encouraged with our overall economic assessment relative to what we were thinking, say, a month or two ago. And I do think we're in recession, or we're about to be, but I think it's going to end up being relatively soft. And that's our assessment, always subject to change, as I already said. Anyway, I think I can stop rambling there and just leave it till next week. Folks, thank you as always for watching and listening. Talk to you again soon. Bye-bye.